lecture, we are going to be looking at sources and forms of finance. Let's start with forms of finance. Firstly, finance can either be classified as short-term, medium-term, or long-term. Short-term finance is repayable in less than 1 year. Medium-term is 1 to 10 years, and long-term is more than 10 years. Now, guys, you'll see just below that the above time frames are not always exact, but they should be used as a guideline. Then, in addition to that, finance can also be classified as either secured or unsecured. If finance is secured, that means that the finance provider has first claim over a specified asset or specified assets in the case of default. And then finally, finance can also be classified as either equity, debt, hybrid capital, or mezzanine finance. All right, so now at this point, you should be comfortable with what equity is, what debt is. We just need to discuss hybrid capital and mezzanine finance in a little bit more detail. Now, guys, hybrid capital includes properties of both debt and equity. So, for example, preference shares would be a form of hybrid capital. Why do preference shares have properties of both debt and equity? Well, preference shares are similar to equity in the way that we pay dividends on preference shares, and we also pay dividends on ordinary shares. And if the company has a bad year where they don't have enough profits or enough cash flow available to pay dividends, they don't need to. So that's how preference shares are similar to equity. Preference shares are also similar to debt in the way that we pay dividends on preference shares at a fixed rate. So you could get 8%, 10%, 12%, 15% preference shares. We pay dividends on preference shares at a fixed rate in the same way that we pay interest on debt at a fixed rate. So that is how preference shares would be classified as hybrid capital, because it includes properties of both debt and equity. Then lastly, we also have mezzanine finance. And mezzanine finance means that if the company is liquidated, the claims of these finance providers will rank above equity but below all other forms of finance. So preference shares are also an example of mezzanine finance, because if the company is liquidated, the preference shareholders will rank above the ordinary shareholders. Remember, in the case of liquidation, everybody else gets their money back first, and the ordinary shareholders rank last if the company is liquidated. Ordinary shareholders have got the most to lose if a company is liquidated. So mezzanine finance means that the claims of this finance provider ranks above equity. So preference shareholders rank above equity. They get their money back before the equity providers, but they rank below all other forms of finance. So they are mezzanine finance, or they sit in the middle. They are directly above equity, but below everything else. Then if we look at the different sources of finance, if a company is trying to raise finance, they can either go to the money market or the capital market. If you are looking for short-term finance of 1 year or less, then you go to the money market. On the other hand, if you are looking for longer-term finance, you then go to the capital market. And it's important to note that the capital market can be distinguished between the primary market and the secondary market. So on the primary market, this is where the company can sell new securities. So if new securities or new shares are being issued, that means money is going to flow from investors to the company. So that's on the primary market. The company is issuing new securities, new shares, new debentures, for example. When they issue these new securities, it generates cash for the company. Money flows from investors when they buy those securities to the company. On the other hand, the secondary market is not where companies sell new securities for the first time, but where existing securities are traded between investors. So this is where investor A sells to investor B. And it's important to note that this does not generate cash for the company. Right. Then moving on to the financing decision. It's important to note that the capital investment decision happens first. So first we perform the capital investment appraisal, where we decide if the company should invest in a particular asset, project or investment. So if we find that the project has a positive net present value, then we know the company will invest. So that is always the starting point. First, we look at the capital investment decision. Then, once we know that the investment has a positive net present value and the company should invest, the next step is to determine how they are going to finance the investment. So in this lecture, we are looking at the financing decision. We are assuming that the capital investment decision has already been made. The project has a positive net present value, so we should invest, and we are now just deciding how we should finance that investment. Now, please note, guys, whenever companies raise new finance, they should always try and move closer towards their target capital structure. It's important to note that they will not always be at their target capital structure. They may be in a position of temporary disequilibrium. So that just means they're not at their target capital structure. They're in a position of temporary disequilibrium. However, whenever they raise new finance, they should always try and strive to move closer towards their target capital structure. If you keep that in mind, it's going to make the rest of this lecture very simple for you. Let's go and have a look at the lecture example. The following information relates to Parker Limited. The market value of equity is 9 million rand and the market value of debt is 11 million rand. They want to invest 6 million rand in a new project, and you can assume that the project has a positive net present value. So the investment decision has been made, the project has a positive net present value, we are going to invest. We now just need to decide how they are going to finance the investment. We are told that the company has a target debt-to-equity ratio of 60-40, and you need to determine whether they have capacity to raise debt finance. So can they finance this new investment over here using debt finance, taking into account the fact that their target debt-to-equity ratio is 60-40? All right, this is a very simple calculation, guys. All you do is you start with the company's existing finance. So currently they've got 9 million rand equity and 11 million rand debt in their capital structure. So that gives us a total of 20 million rand. The new investment is for 6 million rand. Add that together, after they finance the new investment, they will have a total value of 26 million rand. Take that 26 million rand and put it into the target capital structure of the company. Ideally, this company should have 60% debt and 40% equity in their capital structure. That is their target debt-to-equity ratio. So that is how the company should be financed. That is their ideal situation. Compare that to their existing capital structure. Currently, they've got 9 million rand equity and 11 million rand debt. So what we are doing is we are comparing their current capital structure to the target capital structure so that we can determine how this 6 million rand investment should be financed so that the company can move closer towards their target capital structure. So you can see, here's the 6 million rand for the new investment. It should be financed using 1.4 million rand equity because the company currently has 9 million rand equity in their capital structure. So if they raise another 1.4 million, that will take them to 10.4 million and then they'll be at their target. And then the balance, the remaining 4.6 million, should be raised using debt finance because the company currently has 11 million rand debt in their capital structure. So if they raise another 4.6 million rand debt, that will take them to 15.6 million, which means they'll be at their target. All right? So ideally, this is how the finance should be raised. If the company wants to be at their target capital structure, then the 6 million rand finance should be raised by raising 4.6 million rand debt and 1.4 million equity. Now, guys, the problem with doing this, with splitting the finance, is the company is going to incur duplicate issue or transaction costs. Because when they raise new equity, there are going to be issue or transaction costs associated to raising new equity. And when they raise new debt finance, there will also be issue or transaction costs associated to raising new debt finance. So you would never want to split the finance between debt and equity, because then the company is going to incur duplicate issue or duplicate transaction costs. So in this situation, we can see the company only has capacity to raise 1.4 million rand equity, and they have capacity for 4.6 million rand debt. So in this situation, in this instance, a decision to use debt finance would be acceptable, because then they are moving closer towards their target capital structure. They have more capacity for debt finance. So this time they will use debt finance. They will be in a temporary position of disequilibrium. However, they will rectify this the next time they require finance. So the next time they need finance, they'll perform this calculation again, and they will just make sure that they keep moving closer towards their target capital structure. So they won't always be at their target capital structure. They may be in a temporary position of disequilibrium, but they always strive to move closer towards the target capital structure when new funds are raised. Then please note, guys, very important, the above calculation is based on market values and not book values. You'll see I used the market value of equity and the market value of debt in my calculations.